Hello, welcome to another Smart Knowledge U vlog. Today I'm going to speak about incontrovertible proof that one has to consider banker market manipulation in your investment strategies if you hope to emerge from this massive global market volatility all over the world. Doesn't matter where you are, Europe, China, the Americas. It's happening this year, 2015. Probably will accelerate in 2016 and even become worse. So this is basically going to be a vlog in which I just talk about how simple mathematics shows that it's indisputable that central bankers, commercial bankers are manipulating markets and why you must take this into account in your strategies. It's quite easy if you understand basically a simple math concept called the bell curve. So I'm going to show you what the bell curve is. Okay, so here is a picture of the bell curve. Okay. This is a drawing of a bell curve for any event over time. So roughly you can see 68.2% is of the events fall within one standard deviation of the mean. If you see this symbol here, that's sigma. Sigma just stands for standard deviation. So we have 68.26% of all events falling within one standard deviation of the mean. And then we have 95.44%, which is the area right here, falling within two standard deviations of the mean. And then you have 99.72% of outcomes fall within three standard deviations of the mean. So that actually means there's a very minute possibility of only 0.28% of any event falling outside of three standard deviations of the mean. So again, sigma is just another word for standard deviation. So if you can think about the fact that there's only a probability of 0.28% of an event falling outside of three standard deviations of the mean, when we start getting into 4 sigma, 5 sigma, 6 sigma, 7 sigma events, which means again 5, 6, 7 standard deviations from the mean, the possibility of that happening naturally is almost nil. So we can actually break down the probabilities percentage-wise of certain events happening, like a 5 sigma, 6 sigma, 7 sigma event. So let me show you what these actual numbers are. Here they are. So we actually have the probability of a 5 sigma event, which is an event happening 5 standard deviations away from the mean, is only 0.0005733.03% chance of happening. A 6 sigma event has a 0.000001973% chance of happening, and a 7 sigma event right here has a 0.00000000256% chance of happening. So here's another way to frame a 7 sigma event to put it into perspective. So a 7 sigma event would be something that happens approximately once every 3 billion years. So in terms of lifetimes, what that is, because I know most people can't fathom, 3 billion years is extremely long time span. If you're considering even that the average lifetime is a very, very, very healthy 90 years, 3 billion years would mean that a 7 sigma event should happen once every 33,333,333 lifetimes. So it's not once in a lifetime event, that's a once in a basically 33 million lifetime event. So that would show you the tiny probability that actually would ever occur naturally. But let's look at some of the recent 6 or 7 sigma events that have been happening within the global financial markets all over the world in the past 5 years. So January 15th of this year, when the euro plunged by 30% against the Swiss franc in just 13 minutes. So that type of move, that daily move of the euro against the Swiss franc, where it plunged 30% in just 13 minutes, was a 16 sigma event. Remember the probability I just gave you of a 7 sigma event happening. So in essence, what's that saying? Since it's a 16 sigma event, is that event, it's impossible for it to happen without central banker manipulation. Again, if we look at the Chinese stock markets, we had here's a photo I'm going to insert so you can look at the Chinese stock market crash. That was a 6 sigma event. And remember, again, even for a 6 or 7 sigma event, that's not a once in a lifetime event. That should happen once every 33 million lifetime. So again, you can see that the only reason that happened was because the PBOC was ramping up the Chinese stock market. They allowed everyone to borrow a margin, and everyone got crushed because they created basically absolute absurd price distortions in the Chinese stock market. And then the S&P 500 over the past 4 years, that rise has also been a Six Sigma event. So I'm going to insert the photo here again so you can look at it. So remember, again, a Six Sigma event should happen once every 33 million lifetimes, but yet people, the bankers and the politicians and the corporate CEOs try to say, oh no, this 4-year rise in the S&P 500 was natural, and that's happening to sustainable economic growth. But as we saw starting August 20th, obviously those were complete lies, not true, because that's something that should happen. That type of rise, a Six Sigma event, should happen once every 33 million lifetimes. And even with that in every 33 million lifetime event of the S&P 500 rise, we are still beating the S&P 500 in our Crisis Investment Opportunities newsletter from the time of our launch in 2007 to 2015, August 26th, actually as late as I could look at the yields, and we're still outperforming the S&P 500 despite that once in a 33 million lifetime event by more than 27%. So now we can look at even more recent times. So those are just some of the events I covered in the last 5 years, but even in this week of August 24th, we've had again a number of Six Sigma and Seven Sigma events. For example, the Dow Jones Industrial Average Index had the largest 2-point drop in history, and then the greatest 2-point rise in history. Now, as all of you know, I said that the ramp up for the past 4 years was a Six Sigma event, once in a 33 million lifetime event. So it's only natural that I would say that largest 2-day drop was natural. That was bound to occur because the growth in the Dow Jones Index wasn't organic, nor was it sustainable. But the 2-day rise was certainly, it was into actually decreasing volume, which shows you, and actually almost like no volume the second day of the rise. So it's showing that that's unnatural. That again was most likely a Six Sigma event created unnaturally by US bankers. And when you look at the volatility on Monday alone, August 24th, we had 2,588 point intraday volatility. We had a 4,500 point intraday volatility of the Dow futures one day. Now you may think, oh, that's not that high, but if you realize the Dow Jones Index is only about 16,500 points, that's a 27% of the entire Dow Jones Index, the volatility in the futures. That is just ludicrous. And when we look at the whole week, we had more than 7,500 points of volatility in the Dow Jones Index, when the index itself is only roughly 16,500 and some points. So that is just ridiculous volatility. I don't have the stats, if it's been compared to the regular intraday volatility, but since it was the largest volatility in history today, I imagine it's probably beyond a Six or Seven Sigma event. It's probably more like the Euro crash against the Swiss franc, which was a 16 Sigma event, which means actually there's no possibility of it ever happening without banker manipulation. So that's just, and then in addition to that, we had a 5.3% move higher in the Chinese stock markets within just the last few minutes of trading in one day this past week. Again, that has to be like a 7, 8, 9, 10, 15 Sigma event. Basically impossible without PBOC intervention and market manipulation. And we even had the VIX, which is a metric of volatility in the US stock markets. We had the biggest 2-day rise. And we had, what else? I mean, this is ridiculous. You can keep going on and on. We had a move in crude oil intraday that was confirmed as a Six Sigma move. So remember, again, these are all moves that are supposed to happen once every 33 million lifetimes, once every 3 billion years. The possibility being 0.000000256%, and these are happening with regularity. So from a scientific, mathematical standpoint, it shows you how manipulated our global markets are today. Finally, let me talk to you about the people that always say that those of us that say gold and silver prices are manipulated downward by central bankers are conspiracy theorists, and we don't know what I'm talking about, because it's so easy to debunk them with science and with math. Because when we look at these 6, 7 sigma events, I can just look at, well, I'm just going to give you one example from 2011 to 2015 to current day now. In April of 2013, there's a 7 sigma move. So again, a move that's 7 standard deviations away from the mean when we look at the price movements in spot gold over a 5-day rolling period for 10 years. So we're not even just looking for 1 year, we're looking at the mean of 5-day price movements in gold over 10 years from 2003 to 2013. Actually, I think that's 11 years. And when we look at the mean at the 15-day, 15% spot drop in spot gold prices that happened 15% in 5 days in April of 2013, that's a 7 sigma move. So let me remind you what the probability of that happening naturally is. And here it is. If you can see the 7 sigma move, the probability of this being natural would be 0.0000000000256%. So another way of stating this is that there was a 99.99999999744% chance of it not occurring, but yet it did occur. Okay, so suppose I presented, let me frame this just with another analogy. Suppose I presented to you a scenario and I said, look, here's a crane and it has a 2-ton steel pallet, and I'm going to place you an X 50 meters away from that 2-ton steel pallet, and I want you to stand on it. And I'm going to drop this 2-ton steel pallet, and if you're willing to stand here while I drop this 2-ton steel pallet from the crane 50 meters away, I will give you $100 million. But there is a chance that you will die, because there is, let's say it's a 7 sigma event, just like that movement of gold spot prices of 5 days in 2013. So suppose I say that there's a 99.9999999999744% chance that you will live, and the only scenario in which you will die is if a 5 million km/h gust of wind happens to come by the exact moment we drop the steel pallet. It pushes a 2-ton steel pallet 50 meters over and then falls on your head and crushes you. But you know that the chances of that happening is 7 sigma event, 0.00000000256% chance. Now, if I asked 1 million people, I would say 999,999 people would say yes. You know who would say no? The single person that would say no, I don't want to take the world's easiest opportunity to earn $100 million that was just granted to me would be the technical analyst that says that there was no manipulation in gold and silver markets, because they believe that a 7 sigma event, which would be the possibility that a 5 million km/h gust of wind will come at the exact moment we drop this 2-ton steel pallet, blow it over 50 meters and drop on your head. They believe that the type of price movements we've seen that have been 5, 6, 7 sigma events in gold markets and the gold futures markets that have these type of probabilities, they believe that a 0.00000000256% probability event is natural, and they said there's no manipulation taking place. So that is how ludicrous these people are, and they are really morons that they can't see the facts that are out there that would say it's indisputable evidence that there is central banker manipulation going on in gold markets. Now, a lot of these technical analysts, when they try to debunk or marginalize those of us that say it's obvious there's manipulation, central banker and commercial banker manipulation using HFT algos in the futures markets, spot gold prices when they collapse so quickly at certain times over the past 4 years. they will say, oh, look at these tin foil hat wearers, these morons, and they engage in ad hominem attacks. But the difference is, even though I say these guys are morons, it's not an ad hominem attack in my case, because I'm providing scientific evidence that indisputably proves they're wrong, whereas they just engage in ad hominem attacks and show no evidence to support their point of view. Now, before I complete this video about standard deviations of all these global financial events that have been happening that cannot happen without central banker manipulation, let me just address one last claim that technical analysts say against those that say the falls in gold and silver prices are banker engineered. And don't forget that a lot of the ramp ups can also be engineered by central bankers, because bankers can, and I've also told a lot of my subscription clients to my services that yes, a lot of these ramp ups are also banker engineered, because they want to profit from the downside when they engineer the drops that are 6 or 7 sigma events, and they can also engineer steep rises in price and also benefit not only the downside but the upside too. And a lot of these technical analysts will say people that claim that these a lot of the collapses in gold and silver prices that have happened very suspiciously in a very rapid short period of time are only bitterly complaining because it's sour grapes when they were long gold and long silver and on the wrong side of the trade. Now let me tell you something, because I've already told you how much we've outperformed the S&P 500, how much we've outperformed the Philadelphia Gold and Silver Index. And in 8 years of operation, we've actually only had 1 year of bad performance, which was not without its causes, because I explained in great detail why we had that 1 year bad performance on the performance sheet that's available on my website at smartknowledgeu.com, so you can go check it out. And I also explained why that 1 year bad performance will never be replicated again. Even in light of including that bad year performance, we far outperformed the S&P 500. We've crushed the Philadelphia Gold and Silver Index by over 127%, which tells you that over those 8 years, we've consistently shorted gold and shorted silver into raids, into banker raids when the prices have gone down. So there's no sour grapes. And in our platinum membership this year, again, the Philadelphia Gold and Silver Index up until August 26th, 2015 is down 35.5%, but yet all the gold and silver mining stocks that we own from the beginning of the year up until August 26, 2015, we've yielded positive 31.6% to our platinum members. So obviously this is not sour grapes while we're explaining this manipulation to people. It could just be technical analysts that always say there's no manipulation in gold and silver prices. It could just be that there are people out there with integrity that won't be a shill for the bankers, take the bankers' position that there's no manipulation, and we're just trying to tell people the truth. Okay, so please comment below. Let me know if you now understand the absurdity of 5 sigma, 6 sigma, 7 sigma events happening in the global financial markets with regularity. Even this week alone, there's at least 4 or 5 of these events that are supposed to be happening once every 33,333,333 lifetimes, where a lifetime is 90 years. That is just absurd. And also as well, because we have clients from more than 30 different countries for Smart Knowledge U services. If you're someone that's watching this video from a different country, please do comment below. Let us know if you've seen these similar type of 5, 6, 7 sigma events happening in your financial markets, in your global, in your domestic stock markets. And comment below, let us know. I truly hope that you understand why fraud and central banker market manipulation has to be part of an intelligent strategy of what to do with your assets moving forward. So as always, thanks for watching and remain intensely curious. Until next time.